So the first and foremost thing I would say is having a good budget. Down payments, mortgage payments, insurances, those are all huge. Down payment, typically you're looking between 5 to 15%. I think the more the better, but obviously that depends on where interest rates are. We have some very favorable interest rates right now. Mortgage payments is a big one. 28% of your income max should go to a mortgage payment. So, for example, if you're making $100,000 a year, your mortgage really should be right around that $2,300 a month number. So if you want more house, you have to put down a higher down payment to be able to get that, depending on your income. And then the insurances is the one that a lot of people really fail on, is that they have insurance, but they don't have the right amount, or maybe they're overpaying for insurance. And the one that we see, just because I'm licensed to do it, is life insurance.
Right.
A lot of people own homes, and if God forbid something happened to them, how are they going to pay the mortgage?
Exactly. And just to go off of that, that was like one of the first things that I thought about when I purchased my first home. You know, it's basically mortgage protection. I mean, if you don't have a family, it doesn't mean you shouldn't have life insurance, because the home is going to go somewhere and you just don't want to pass on any debts to relatives or whoever your property might go to. But, that's a great point.
And I'm not an insurance salesman, but these guys have gotten really good too.
Right.
They have these new products that you don't even need to die to benefit from. If you become disabled or critically ill, or you can't work, some of these products will give you some of the cash from the death benefit up front to help you through those tough times.
That's a great point.
And I'm not an insurance salesman, but it is something that's part of the financial plan. So having the right amount of life insurance is equally as important as having the right amount of homeowners insurance, having the right flood coverage, having the right car insurance, having the right rental insurance, because all of these things make this huge objective of a home and the overwhelmingness of what can happen from day to day, whether it be, a situation like the housing crisis in the mid-2000s or something even like COVID. They make it a little less scary and a little bit more comfortable, so your family isn't going to be impacted by any of these kind of unforeseen circumstances that we have happen from time to time. So as far as advice, get your budget in order. Make sure that you're working from a comfortable standpoint for all of your payments, and make sure that your insurances are ironclad.
Right.
And if you haven't reviewed them, we're going to review them. We're going to make sure you have the right coverage at the right time at the right price. And I believe that kind of leads us right into that next question that we're going to.
Well, actually, one question, not to get away from that quite yet, but what percentage of a portfolio would you suggest, real estate should take hold of?
The economists, they find 10 to 15% not only reduces risk, but actually can increase returns.
Okay.
Because it has a different correlation than, say, a stock or a bond. So that different correlation, and by the way, you don't need to own real estate, the brick. You can own land, you can own a real estate investment trust in the stock market, but 10 to 15% is that sweet spot that gives you extra reward for a little less risk historically.
Absolutely. No, that's a great point. And, obviously the Home Designer Remodeling Show, we're in the business of improving people's homes, improving their lifestyle, really delivering moments that people can achieve in their home. Give me 3 tips that you can offer homeowners for when it really comes to improving homes and, creating that budget for making home improvements.
So budget, and have that cash reserve.
Because it's intimidating, Where do you start? How do you know how much you should spend, or what's the comfortable level?
So the rule of thumb, Journal of Financial Planning, says 3 to 6 months of expenses is what any person should have in cash reserve, any family. So let's say you're spending $10,000 a month, Adam. So on the low side, $30,000, and on the high side, $60,000. But let's talk about leverage. So if you're on that high side at $60,000, now you have wiggle room of $30,000 that you could spend without risking an emergency, a job loss, a death or disability that would affect your impact or your retirement portfolio. So it gives you a lot of wiggle room. Now, if you're at that low end and at $30,000, now we're in a different sort of dynamic and a different sort of potential risk situation, because if something does come up, now we're below that threshold that you should be at for cash reserve.